All right, let's break down the latest earnings from CME Group. You often hear them called the toll road for risk, right? Well, after this quarter, it looks like they're getting ready to spend some serious cash to add a few new superhighways. Let's get into it.
So right away, here's the big puzzle we need to solve. CME put up some absolutely fantastic numbers, a record year actually, but the stock's reaction? A total shrug. So what's going on here? What has the market seen that we're not seeing in these great headline numbers?
Okay, so to really understand that disconnect, we have to start with the numbers. Let's just rip through the headlines.
First up, adjusted earnings per share. CME came in at $2.77, a really solid print. Now, that number did beat Wall Street's expectations, but only by 2 pennies. And look, a beat's a beat, but when it's that narrow, it's the market's way of saying, yeah, we already knew you were going to do well. And that's our first real clue about the muted reaction.
Revenue also looked fantastic. It climbed more than 8% from last year, hitting $1.65 billion. I mean, by any measure, that is some really strong growth.
So you've got the solid earnings beat, you've got the strong revenue, and here's the result. The stock finished the day up just over 0.5%. Barely a blip. That is the lukewarm response we're here to figure out.
So let's pop the hood. What exactly was powering this record quarter? And why on earth wasn't it enough to get investors excited?
Well, no surprise, the engine here is trading volume, and in the fourth quarter, it was just firing on all cylinders. Average daily volume, or ADV, was up 7% to a staggering 27.4 million contracts a day. It's a pretty simple equation, right? The more risk people feel in the world, the more they use CME's products to manage it.
And you can bet management was taking a victory lap. CEO Terry Duffy was pretty clear on the call. He said this was, and I'm quoting here, quite simply the most successful year in CME Group's history.
And this wasn't some one-quarter wonder. We're talking about a record full year, with market data revenue surging 13% in the 5th straight year of record trading volume. That momentum is even spilling into the new year. Management's got a name for this, the risk-always-on environment, and that's exactly what's driving demand.
So if the business is firing on all cylinders, what's the problem? Well, this is where we get to the other side of the story. It's all about the spending plan. And this is almost certainly why the market is hitting the brakes.
Management guided their adjusted operating expenses for the coming year way up to nearly $1.7 billion. Now, for a company that's known for being pretty efficient, that's a big jump. And when spending goes up that much, Wall Street's eyebrows go up with it.
So where's that money going? Well, they're making a major strategic push on 3 big fronts. They're moving into the absolutely massive U.S. Treasury clearing market, they're expanding their crypto products to trade 24/7, and they're building out new prediction markets to attract more retail customers. Each of these is a huge investment designed to widen that competitive moat.
Management also talked about another, more subtle growth lever, pricing power. Basically, their ability to raise fees without customers leaving. They're planning some fee changes that they think could add another 1 to 1.5% to total revenue. For a business this size, that is an incredibly powerful tool.
Okay, so let's put all the pieces together. You have record performance on one side, but you've got rising costs and a pretty hesitant market on the other. How do we square this?
This really captures the whole debate perfectly. The bulls look at this and see a fantastic business adding new lanes to its toll road for the long term. The bears, well, they see the construction costs. They're worried that the higher expenses will drag on earnings right now, and they're pointing to the risk that these big new projects might not pay off.
So, after weighing all of that, our official call on the stock for the next quarter is market perform.
And here's the thinking. The company's current strength, how great the business is today, that's already priced into the stock. The market is now in a show-me phase. It wants proof that these big investments are actually going to deliver a return. And until that proof shows up in the numbers, that higher expense guidance is probably going to act like a ceiling on the stock price.
But for those of you looking to maybe put a trade on around this dynamic, let's shift gears. Let's talk about a wild card idea, the kind of thing you might hear in a hedge fund pitch meeting. Because the real question for any active investor is, how do you actually express a view on a show-me story like this one? Well, the play here is what's known as a pairs trade. You go long on CME Group, but at the same time you short the XLF, which is the big ETF that tracks the entire financial sector. The thesis is simple. You're betting that CME's unique growth drivers, like crypto and Treasury clearing, are going to help it outperform the rest of the sector.
It's a way to bet on CME's specific story while kind of neutralizing the risk of a broad downturn in financials.
So, to sum it all up, CME is making a huge, calculated bet on its future. They are spending money now to build the infrastructure for the next decade of growth. For investors, the billion-dollar question is pretty simple. How long is all that construction going to take?
And as always, a reminder, this is not financial advice.